If you don't sell during the lows, an 8% autopilot investment is a good investment. But where the stock market, I find, has a lot of trouble is creating income. You could be a millionaire, but if you're only taking home $10,000 to $20,000 a year in income, you're going to feel pretty damn poor.
Welcome to the Going Long Podcast. We're back once again to continue to help to educate you so that you feel much more comfortable as well as confident investing beyond your backyard. And yes, once again, I am your host, Billy Keels, and I am super excited to share today's conversation with you because I know you're going to get so much out of this. And, before we even get to that, and I'll get through this really, really quickly, but I'm just so excited because we continue to move together with you up the charts in terms of top rated podcasts, most recently in the top 1.5% of podcasts globally. And there are over 2.8 million podcasts in the world. So thank you very much for continuing to be here, continuing to download and continuing to take the action on the information that you are learning here. So, and one of the great ways that we also continue to move up together is thanks to you and the written reviews as well as your ratings that you're leaving for the podcast, specifically on the Apple platform. We also have other platforms and we make it easy for you to be able to do that. But if you haven't had a second to do that yet, if you could just take just a couple seconds, think about your favorite episode, what you learned, or think about the things that you want me to change and do differently. So feel free to leave that honest written review as well as rating. Greatly appreciate that. And also, I know a lot of you like to look for other resources, or you really want to understand, like, where are the podcasts? Like, you can't find them on your favorite platform. Well, you can find every single podcast, the video version, the audio version. Just need to go to billykeels.com. Once you get to billykeels.com, go to the podcast tab and you can find every single episode. It's awesome. All the guest responses, all that kind of good stuff. Once again, it's billykeels.com. And once you get there, look under the podcast tab. So, and one last thing, a lot of you are accredited investors and you keep wanting to connect with other accredited investors and part of a club, or you want to look at new opportunities that are available. And we're getting started with our accredited investor club. And if you want to know more about that, send us an email to aiclub@billykeels.com. Once again, it's aiclub@billykeels.com. And I will respond to you. We'll get in contact. We'll find out a little bit more about what you're looking for. And we'll love to onboard you as one of our new accredited investors in the club. So with that, I really would love for you to reach out, aiclub@billykeels.com, and it's going to be really, really awesome. So with that also too, there's another thing. So many of you are not just accredited investors, you're looking to do things differently. You started in real estate and maybe you got started in the stock market, or you come from a family where you weren't born with a silver spoon in your mouth and you just wanted to be able to get ahead, and you were looking and you're here and you're now working in a corporate role. You like it and you know that there's something else out there, and there's a lot of different tools available, and you are tired of just being in the stock market and you're looking for different alternative assets that you can invest in to have more control over your life. Today's guest really jumps into a lot of different things that he learned, even at age of 14, had a stock market experience, then went from there and got started in single family residences, had some specific things happen to him there where he realized that this was a model that was not going to scale. He shares his story with you. He's gone in to now do a number of different types of investments, everything from ATM machines. He's also invested in things or used other tools like life insurance policies, things like that, and investing actively as well as passively. He's got his own income fund. There's a lot of really great ideas that you'll be able to take away from today's conversation that we're going to have with Denis Shapiro. And we're going to get to that conversation coming up right after this. Whether you're an active investor or a passive investor, you really like your day job and you want to continue to go into your day job every single day feeling better, knowing that you've created the right options for yourself. At the same time, you just don't have enough time to really get your head around, spend all the hours investing long distance. Well, one way or the other, over the last number of years that I have been investing long distance, I've really understood a number of the major mistakes that you should avoid if you want to get to creating the right options for yourself much faster and being able to create more income sooner. And if you want to do that, if you want to understand more about that, I've made it really, really simple. You can just go to billykeels.com/7 mistakes to avoid. You can learn all the things that the 7 major mistakes that I've seen over and over again that I want you to avoid. Once again, you can go to billykeels.com/7 mistakes to avoid. So, you know what? If you've ever wanted to know how alternative investing specialization can lead to the freedom that you're really looking for, then guess what? You're going to love today's conversation and you're going to want to stick around until the very end. You know why? Because today's guest not only started his career as an operations manager in the medical profession, he also then moved into a marketing role as well as worked as a technical expert for the US government. That sounds very interesting. He is also the author of the book, The Alternative Investment Almanac, and he's the managing partner at SIH Capital Group. It gives me great pleasure to welcome to today's conversation, Mr. Denis Shapiro. Denis, welcome to the show, man.
Hey, great to be here. Thank you for having me on.
Hey, Denis, man, you got a really, really awesome story. And I know so many people that are part of the Going Long family, like they're going to love this story today because you got a lot in common with so many of the different high paid sales professionals, the legal professionals, the medical professionals that are part of our audience. And I know they're going to absolutely love your story. So with that, man, we're going to jump in. So like all of our guests, you're going to get 2 questions in the beginning. You're going to get 3 in the end. And in the middle, well, the Going Long family is going to get a chance to get to know much, much more about you, the things that you're doing so that they can be inspired to go out and take action just like you have so far. So very first thing, let's jump into this. Help us understand, like, where do you live in the United States?
Yeah, I live in central New Jersey. So I'm about an hour away from Philadelphia and about an hour away from New York City. I was originally from New York City. I came to this country. I came to the United States when I was 3. I come from a country called Belarus in Eastern Europe. And I basically lived almost my whole life in New York City. And then I recently, a couple of years back, I moved out to Jersey.
Oh, fantastic, man. So that sounds great. Central Jersey. I know that. I know the area well. Maybe we can talk about that a little bit more offline as well. And originally from Belarus. So that is absolutely fantastic. So help us get started off as well with some positivity. Help us to understand what's the most positive thing that's happened to you in the last 24 hours, Denis?
We got to do a webinar on one of the deals that we're active on. And that's always a cool experience because I have a huge background on being always passive. And then last couple of years, I've had some interesting opportunities that I got to be on the active side. So just being, you go from being the student to being like the professor. It's a cool mindset change. And, it's a nice part of the path.
Oh yeah, man. That's all part of the path to becoming. And I love the fact that, as you say, you talk about and we start out in the very beginning, like it's getting to the point where you're taking action. So yes, taking action, passively investing, and then also leading those conversations and helping formulate the ideas and opinions of others so that they can get to the goals and dreams that they're looking for. So that's awesome, man. And really appreciate you sharing that positivity with us before we get started. And I always say this, man, but I give myself this really impossible task, Denis, of trying to tell your entire story in like 4.5 seconds. It's not possible, right? But I always want to push myself to the limit and try and do that. So you've got a big story to tell. And I would love for you to share your story, the backstory in your own words. And also, as you tell your backstory, Denis, the one thing that I would ask you to do is if you could share some of like the major inflection and or decision points that you've made to get to this point in your journey. And then you and I can see kind of where the conversation goes from there.
Yeah. So I was given a copy of, I know me and you were talking before the airing about Rich Dad, Poor Dad. I was 14 years old. My oldest brother gave me a copy of Rich Dad, Poor Dad. This is, close to 20 years ago. I read it, absolutely hated the book. Thought the guy was like a big scam because I was like, oh, this guy definitely makes more money on the tours. On the book than, the message in the book. But I did get out of it that I should probably invest. I had a part-time job. I come from a very poor household. My mom worked 2 types of jobs. So it wasn't like she was giving me money to invest, but I worked part-time. I worked the whole summer. And I put my first $1,000 into the stock market. I did it the wrong way. As you'll hear, that's like the consistent theme in my story, is that I always did it the wrong way at first. But I went to my oldest brother and I said, hey, what do you do? And he was like, oh, I'm doing mutual funds. I was like, all right, that sounds like a great idea. Let me do that. Did it, followed it for like a whole year. Obviously, it wasn't a lot of money in it. I think it was like $1,000 at the time. But I remember logging in, thinking I was going to be like rich on the next login. And I remember the whole year it went up by like $7. And that was like the cost of the trade because I'm old enough to actually remember paying for trades. So I was like, all right, this is not really a good strategy strategy. What can I do better than this? And I'm like, but I was only, at that point, I was still 14 years old. I was like, all right, let me do my research. And of course, I stumbled onto like the Wall Street legends, the Buffetts and the Peter Lynches and all the traditional legends. And I got hooked. That's all I wanted to do. I was 15 years old. I was reading analyst reports. I scraped the whole mutual fund. I started building up my own portfolio. I was, on the quarterly conference calls, and I was going to my high school. I literally picked one college. I was like, I'm going to the best business school I could get into because this is what I'm doing. I'm going to become an equity trader or some kind of portfolio manager. And that was my goal. That was my major goal. And then a huge inflection point was I went to business school right in the heart of the global financial crisis. So it was like, boom, smack in the middle, where I was going towards internships and I was getting interviews. And usually in the business world, it's not one interview, it's like a series of them. And I was getting to that third interview, and the companies that I'm interviewing for, like, oh, sorry, we're actually closing. The whole company's going bankrupt. And I was like, oh, okay, so what should I do? So I was in an inflection point. I was finishing my bachelor's in business. So I was like, all right, I guess I should go get more school. I guess that's the answer. So I went and got my MBA from the same business school. I was really fortunate. They actually even accepted me at that time. And while I was getting my MBA, I got recruited for the government. And while I got recruited for the government, the first paycheck I got, I was like, wow, it's great. Not only are they my employer, but they're like my business partner because of the amount of taxes being taken out. So I came home that day and I was like, all right, how do I pay taxes? How do I pay less taxes? Right. And then like the first page was like full of semi-illegal results. So I had to go back and be like, how do I pay less taxes legally? And the first 10 things were all like real estate. And I was like, okay, so I was like, so I should be doing real estate. I already had a couple of years under my belt with the stock market, but I wasn't looking every day with the stock market with the global financial crisis. So I had, time to really develop new skills, new investment skills. So I went to my older brother. I'm like, hey, you got a portfolio. You have like 8 units. Which one do you want to sell? And again, this is not the way you should do it. Where he literally looked at his whole portfolio. I was like, oh, this one's giving me the most, trouble. Here, take this one. And I, cut my teeth on that deal. It was a low income housing play. I dealt with evictions and the affordable housing and basically everything you can imagine in like a 6-7 year span. And during that span, I was like, yeah, I definitely don't want to scale this. This is nice. It's local. It's in my backyard. But this is not what I want to scale because I don't want to scale the headaches. And I was property managing myself. I was dealing with the renovations myself. I was dealing with consistently looking for my tenant because his phone was always out of service. It was just like a whole series of these things where like, yeah, this is not what I want. I still need the whole alternative sides. So what should I do? And then I kind of went down a rabbit hole where I started getting into more passive stuff. So it's kind of like I went active first with my own single family rental. And I was like, all right, this is not really for me. At that time, my career was kind of taking off. I was like, I don't really have the time. So then I really focused on the passive side. And that's when I started building like a collection of alternative investments like ATM funds and life insurance policies and syndications and all these different varieties of passive investments that kind of started lending themselves to each other. So when I started learning about apartment buildings, it was easy to transition into self-storage and mobile home parks and all these other asset classes because their terminology is the same. And then as I started building the network, it just kept growing and growing. And then that was kind of like a path where I went from the single family rental to a huge portfolio of passive investments. And then once I kind of reached the point where I was like, okay, I really know what I'm doing from the passive side. The last couple of years, I've been transitioning to the operational side. And that's the side where I actually co-asset manage the properties. And I have my own income fund that I have through SIH Capital Group for people who are looking for like that steady income and capital preservation. So that's kind of like my story in a nutshell. Be glad to take it any way you want from there.
Yeah, man. So I mean, you finish your story talking about helping others with things like capital preservation through your own income fund, but you started out as a 14-year-old kid sharing with us this kind of experience, and you decided that you want to get into the market, and you put $1,000 and you're kind of watching the things that are happening. So But I guess a lot of things resonate with me as well. Cause I mean, both of my parents, neither one of them went to college. They both worked 2 jobs. I mean, they were just, I definitely, I wasn't born with a silver spoon in my mouth. And so if I look about all the things that happened, you mentioned something that was pretty interesting. Now, it didn't happen to me at 14. It happened many, many years later, but I'm just curious. So you put that first $1,000 in, and after you kind of watched over the period of time, I think you said it was like a year. And so at the end of a year, you earned like $7. Let's just be really, really nice and say that you earned $50. And then there was 7 that you had to take away from the trades that were made. I'm just curious, how much emotional energy did you spend over that year watching it go from 1,000 to 1,100 to 850 up to 1,200, down to 1,000, down to 750, all the way to at the end of that year that you were up 50?
That's a great question. Like in hindsight, I don't really remember the exact amount, but I do remember that you were getting like emotional highs where like, hey, I was working a part-time job. And at that time, like a good part-time job was like $100 a day type of situation. Yep. So I remember days where I logged in, I was like, oh, I made more money in the stock market than I did my physical world. So there was a cool sense of like this relationship that you could have between your investments and already replacing your income. I think it was pretty like eye-awakening. But then I guess I always had the ability to shrug it off really quick on down days. And I think that's actually been, I don't think I've ever sold in a downturn in my entire life. So I've always had that emotional ability of like, hey, the market will go up and down. So I think from an early age, the downs weren't so significant to me, but the ups were really cool and fascinating.
Yeah, which is pretty interesting, right? Because that's how the human psyche works. We tend to, over time, we forget about the lows and we tend to think about the highs. But I also, one of the things that I tend to notice, because I deal with a lot of people that are interested in making a switch, maybe from the stock market to something else, and they'll tell me about the days that things are going really, really well. And then they're nervous on the days that they go really, really bad. And so there's always, and I love the word that you said, it's like you feel, because there are some days when you feel like you made a lot. And then there are other days that you felt like you lost a lot, but there's a lot of emotional energy that is on this roller coaster, but it's very unlike the alternative quote unquote investment space where there's actually just a deposit into your bank account. And that's real. Like that's not an emotional feeling up or down. Like that's a real deposit into your account. So I don't know if you have any thoughts around that, or if you've given a lot of thoughts to that, or as you talk to other people about that, but I'd love to know your feeling around that.
I do. I think that's a great point, because there's that instant gratification that you could always log into your, traditional stocks and bonds portfolio and see up to the minute. And I've always made the argument that's like the worst thing possible for most investors. So I am actually I think I'm a rare breed, because I do have, I wrote a book on alternative investments, but a large part of my book was about how to marry both ideas, where you take the pros of the traditional side is in one sense, it is nice to have some kind of liquidity, right? So if you have a portfolio and you're looking at it as a circular pie, right? If you cut it in the middle and just keep it that simple, where on the left side is your traditional stocks and bonds, and then on the right side, you carve it up with all these alternative investments. I feel, again, this is not financial advice, but I feel like you're going to be in a much better situation mainly because of this reason, right? The market goes down, let's say during COVID, and it was going down 10% a day, right? So if you had a portfolio that was all in the market at that time, that is an emotionally draining experience, seeing that type of level drops. Now, if you had a portfolio where, you might have $1 million in the index fund and you have $1 million in these different alternative investments that we could go over, then your drop wouldn't be that significant. And at the same time, I also believe you can't be 100% in alternative investments, because most of them are private securities, and you can't get access to that money if you really, really need it. And you're going to have like a fire sale on your asset. So the combination of the two work really, really well. It's just the problem is I talk to investors and they've already made the switch, and they're like, oh, I'm never going to put money in the stock market because I was a victim of that crash. And then I will talk to people who only do the stock market, and they say, well, I'm never going to put money in alternative investments because that's a bunch of Ponzi schemes. So it's like the middle ground where people actually say, okay, you know what? The stock market does have an unbelievable track record, right? If you look back from like a 100-year chart of like the Dow or the S&P 500, you have average compounding returns of 8%. If you don't sell during the lows, an 8% autopilot investment is a good investment. But where the stock market, I find, has a lot of trouble is creating income. If you're not stock picking and you're just doing an index fund, usually the returns are like 1 or 2%. That's not gonna. You could be a millionaire, but if you're only taking home $10,000 to $20,000 a year in income, you're gonna feel pretty damn poor. So that's where I always see it struggled. And I tried to do it with the traditional side, where I tried to do the utilities and the REITs and the MLPs, and the same thing always happened. The way that the algorithms work these days is when the market goes down, those things go down just as hard. And the high yield does not protect them as they used to protect them. So what I found is that my traditional side, if I leave it on autopilot, put it in a low cost index fund, set it, forget it, great. It's going to take 1% of my brain power. But now I have that whole 99% of my brain power to focus on alternative investment, focus on networking and talking to really awesome people and talking about different business plans. And I could spend all that time and focus because now I know my alternative investments need to take on the roles of creating that income and capital preservation that the traditional side I don't need for. So it's kind of like having the pros and cons and realizing that they do both have pros and cons. You just got to figure out how to put it in your own portfolio.
And when you're able to look at an individual portfolio and you can say to yourself, okay, what are the right tools to help me get to the objective that I'm looking for? It can take on many, many different forms. And once again, what I want you as a Going Long family to understand is, a lot of the brilliance in what Dennis, what you're saying and sharing with us is, it's not how do you do one or the other. It's a matter of, and I always love to talk about like hashtag the power of and. How do you do something that provides you with liquidity and tax benefits? Or how do you do something that is growing over time and providing you with, the consistent cash flow? Like this is some of the different things that we do, because it doesn't need to be either or. Wow, don't you just love this conversation? This is amazing. This is fantastic. And so just really quickly, I just wanted to remind you, for those of you that are looking to create more options for yourself, get there faster, and do that with long distance investing, make sure that you go to billykeels.com/7 mistakes to avoid so that you can avoid all those mistakes, get to your goals faster and sooner. Once again, that's billykeels.com/7 mistakes to avoid. Now back to the conversation. Right. And in the same way that we talk about either or, like I think you and I talked about this before. I know that we talked about this before, and it comes back to the whole thesis of this show. And I want to pivot just a little bit because one of the things that, I read Rich Dad Poor Dad as well. I wasn't 14. I didn't have that insight at that point in time to be able to even be exposed to it. But one of the things that I always read was, hey, listen, if you want to have or invest in real estate, that you should become a landlord and you should buy in the places that where you live. I fundamentally don't believe that. As you know, I live in Europe and I invest exclusively in the United States. It doesn't mean that I don't believe that you cannot be a local landlord, understand, invest actively, and all that other kind of stuff. But one of the things that I know about you, Dennis, is you've been able to combine the two, like the power of and, once again, actively investing in a local market. And at the same time, you kind of went against the popular culture when you decided to invest long distance, and you did it in a way that is maybe passively. So the question I really want you to help us understand here on the Going Long podcast is, why did you decide, like, what was it within you that said, hey, you know what? I've been doing this active investing thing and it's worked out pretty well for me, in that I gained a lot of experience, even though I realized, and I think you said that you didn't want to scale this model. I think it was a nice way for you to put it. But what was it inside of you that said, hey, listen, this whole thing of investing in a place where I'm not actually living and could potentially be hundreds, if not thousands of miles away, why in the world did you do that?
So that's a great question. I think that comes down to where you are at in your own capabilities. So when I went away from the single family rental and I started investing passively, I realized from a time commitment, and I realized from just like Dennis Shapiro, the person who does research, what investments look best to him at that current moment in time. And a couple of years back, it was still the concept of investing in commercial real estate really depends on certain fundamental elements like the population growth and the job growth and all of that stuff. Unfortunately, I live in the Northeast. And the Northeast does not have a lot of that in abundance. But where it was in abundance is basically the Southeast of America. It's like the Texas and Georgia and the Carolinas. There's like that little smile. That's where all the money was flowing. Yep. So as an investor, I kind of was like, okay, I could invest locally and do everything myself, or I could invest in the best team I could find in the best market. And that answer was always, when I compared the two, investing passively won hands down. Now, after a few years and after doing 12 or 15 of these passive investments and understanding all the nuances from an investor perspective and having networked with certain operators, that's when I opened the door to potentially being more active in some of these deals. Like I'm working on a deal right now. It's affordable housing deal. The operator is a co-investor that I met who invested also passively, but his core is affordable housing. Now, usually I would stay away from that market, but he's an operator I really, really admire, respect how he does it. And on the flip, and as a bonus, he is also local. Mm-hmm. So for the first time, being invested locally actually started looking as good or better than investing passively out of state, because I already had a huge portfolio of these out of state syndications. Mm-hmm. Now I could pivot and I could say, wow, this is actually a really cool opportunity. Yes, it's local. And yes, it does have some of the negatives of, not as strong population growth stuff, but there was a ton of positives on that deal. Like we were looking at this deal was built in 1998 and it was from a seller that he previously purchased from. And it was a rinse and repeat business model. So I was starting to look at that. And once you get to the point where you could actually compare and say, does it make more sense to actually invest actively or passively? And only you will really know that answer. Now, most of the time, if you don't have the time in the network, it's passively hands down. Yeah. But once you could get to the other side, then you could do both. And it's not like I'm going to stop investing passively. It's just I'm really excited to get more into the active. And honestly, I think being more active in certain deals will also make me a better passive investor.
Yeah, so I love that, and you said it twice. Like investing passively, hands down, was what was you noticed at a certain point in time. So there are a lot of very busy, high-paid professionals, right? And I say it all the time. A lot of software sales executives, a lot of them that are listening to the podcast and watch our videos. A lot of doctors and a lot of lawyers that are watching and listening to us. And typically, these are profiles that like to have control. Right. And so even if it's just having control over the bets that you place in the stock markets. And yes, I did say the bets that you place in the stock market. I know you can study it and all that other kind of stuff, but the bets that you place in the secondary market. And so sometimes, even though it sounds very good, Dennis, that this whole passive investing, sometimes it can be a stretch for someone who is used to having so much control over everything. And people can get caught in, I've had a very similar experience to you when you talked about the active investing versus passive investing at a certain point, right? But what would you say to that person that is so used to having control and that really makes a lot of money, like the return on their time and their job, like it's a lot. And so for them to do that, to go to managing a property or being able to buy one apartment, or not one apartment building, but buying one house or two houses, what would you say to that person so that you can maybe help them over time to realize, hey, listen, there's another way to be able to do this?
Yeah. So what I would say is just because you're not the operator does not mean you don't control your decision and portfolio, which I think is the biggest. As long as you could buy into the pros of that asset class, then it's actually, I would make the counter argument and say you're actually in more control because of this. If let's say you choose not to invest in these alternative investments, right? And you just say, hey, I'm going to go with a financial advisor. And I'm going to trust my financial advisor. They'll allocate the portfolio whichever way they see fit. We'll have our yearly reviews, and I'll feel bad. I'll feel really good if my portfolio is up or down. But the truth is, what do you learn in that process? Right. And I would argue literally nothing. So if you go through a year with a financial advisor and at the end of the year, you're up 30% or you're down 30%, you have learned zero. And your financial advisor might have learned zero in that process. Now, on the flip side, if you go into the alternative investment space, you're going to at least look at a couple of offerings. You're going to at least listen to a couple of webinars. You're going to choose your operator. You're going to network maybe with a few investors. You don't need to network with hundreds. You need like 4 or 5 good people that you could get on a call maybe once a quarter and say, hey, how are your deals doing? How are my deals doing? And just have that honest conversation. It doesn't take much, but once you could build a little network, have a set of operators that you like, that portfolio is your putty. You could, I like deals that are in this specific market with this specific operator. These are the only deals I'm going to do. Great. That's your control. Or I'm going to build a well-diversified portfolio of, 10 different states. I'm in 10 different markets with 10 different operators with 10 different business plans. And I'm going to see how everything plays out. And then I will adjust my portfolio. And it doesn't take that much time. But I will argue that if let's say you have $1 million to invest in these alternative investments, if you put $250,000 day one and $250,000 in 6 months, and then $250,000 in 6 months, and then $250,000 in 6 months, what you will get after those 24 months or so, you will be 100 times better investor than you were day one. And you will never, ever get that from just going with a financial advisor after 2 years.
I don't know. I do have a microphone, but I'm talking in it right now. But this is one of those moments where you kind of want to just drop the mic and go, boom. Okay, there's nothing else to say. Dennis just left it all there. So if you're running on your treadmill and it just went silent, it's because Dennis just left it all there. And I love the fact that you talked about what do you learn? Because typically lots of people that are the profiles that I talk to you about, the reason that you tend to be the best at in whatever profession you are is because you're doing the reps. And when you do the reps, you learn. You very rarely are going to get to the top of your profession if you haven't learned anything. And you only learn by actively being involved. There are many moments where I've spoken to people that are high paid professionals and they say, well, you know what? I just leave it to my person and they make all the all of the financial decision. I'm thinking, well, a lot of you have children. Like, would you just leave your children with somebody and go, you know what? They're just taking care of my kids. I'll never see them. I'll see them once a year. Oh, no, you wouldn't do that. And it's a brilliant explanation that you just gave, Dennis. I think that's fantastic. So just on that, because you've made the transition from, or you're able to do both, right? As a passive investor as well as an active investor. But maybe if you could talk a little bit about when you are actually looking to work with a specific operator, or you're looking to vet someone, or the due diligence process, how do you know that you are working with someone that's going to be aligned in terms of the values that you have, and they're going to be able to help you deliver on the promise that you're looking to them deliver on, or the benefit that they're going to help you get the benefit that you need?
Yeah. So at this point, I think it's a very different question when you're first starting out than when you're a couple of years in. When you're first starting out, it is really hard to know who to trust and everything like that, because what you don't understand is that it's not a real estate business. It's a marketing business for a lot of these syndicators, and they come off as the most knowledgeable, as the greatest operators. And, they'll give you a track record of their best performing deal ever. And it is very, very hard. But as you start becoming a better investor, and what I mean by that, honestly, it's just about networking and educating. The best part is it's like you only have to do that thing. You only have to do it once. If you network with 5 good people, like the dividends you will get from those 5 people are like infinite. You will, on a quarterly basis, you just need to catch up on their calls, and they will recommend the operators that are crushing it in their portfolio, as you will to them. So it only takes a little bit of time and effort to get to that point. And then once you're at that point, you really are not looking for new operators. Now, it's very different for me because I am a fund operator and I also operate my own deals. But again, I'm not out there looking for 100 people to partner with. It's like the person I'm partnering with on our affordable housing unit. The funny story is we were going together to an open house. So one of our operators that we invested in had an open house for a 300 unit building that they were purchasing. So they wanted to show it. You get to walk with the property manager, and great. So it was in the Carolinas. So it was an 8-hour drive during COVID. So I asked the operator, I was like, hey, do you know anybody else taking that drive? And they said, yeah, I actually have someone else. His name is Anthony. He's like, why don't you touch base? We touched base. And my wife was like, I remember her reaction. She's like, you're going to get in 8 hours in a car with someone you've never known. And I was like, he's a real estate investor. We'll find something to talk about. So after that car ride, literally, we spent 8 hours. We literally were invested in so many of the same things. We had such similar philosophies. We spent the next 2 to 3 days, on and off together. And then we were coming home. And I have this thing. Every time I meet someone, and as long as they show some interest, I'm like, literally, let's throw it in the calendar once a quarter. We'll catch up, whether it's 15 minutes, 30 minutes, or an hour. I will give my time. I'll find out what you're up to, what you find out what I'm up to, and put it in the calendar. And that's what I said to Anthony. I said, Anthony, I literally dropped him off. I was like, let's make sure we stay in touch. And here's a hint. I never say, let's stay in touch. I say, hey, let's put something in the calendar. How about this date, a month away from now? And there's no excuse. Usually people's calendar don't go that far. And he's like, yeah. And then he's like, I know you're driving home. Do you want me to send the calendar invite? And I said, sure. And I made that mistake because Anthony went ahead and instead of quarterly, he put it weekly. And I didn't have the heart to tell him, no, that's too much frequently. But I was like, you know what? If he was willing to put in that investment, and he had already a lot of units under his belt, he was a serial entrepreneur. I was like, if he's willing to put in that time, it would be foolish for me not to. And it was a time that worked for us. We both have minor kids. So we did like a 10 o'clock in the evening type of thing. So yeah, it cost an hour of sleep. But I spent the next year and a half literally talking to him every single week. And when that deal came up, we were already talking about it for months. Yeah. And it was just a logical partnership. And so that's why, it's not as... Once you get to that point, operational, you really should know someone as well as an hour call a week. But once you're as a limited partner, you just really need to know the basics, and the learning curve goes down so drastic. Where the first deals that I looked at, it took me like an hour and a half to go through the deal. Yep. These days, I could look at a deal within like 4 minutes. I will delete it or say, oh, this looks interesting enough where I should look at it more. So that's just my advice to to your community. You don't have to, there are different levels of how you need to approach it. And it doesn't have to be, the main thing is lean on your network, because you'll get both the opportunities from a passive side and you'll get opportunities from the active side from your network.
Yeah, and I love that. Aside from just being able to lean on your network, it's take this very similar steps that Denis he's sharing with you right now, which is number one, he invested the time. Now this kind of happened. It just so happened that way. But then also you were gifted this opportunity to speak once a week, and you were kind of like, all right, well, if he's going to do it, I'm going to do it. But you developed a relationship. You invested your time. And when you invest your time and you develop the relationship, when the opportunities appear, guess what? It's not with the people that are like, hey, let's stay in touch. No, it's the people that say, let's put this in the calendar and let's make sure that we're speaking once a quarter, once a month, once a week, or once a day, whatever the relationship is. So I love the way that you broke that down for us. It's fantastic. So listen, before we get into the going long final three, I'd love for you just to share with us quickly. I did mention earlier the Alternative Investment Almanac. And it's as a passion project. I love asking people that have written books, kind of what was the inspiration for it, and as you've written it, what is your end game with having the book written?
Yeah, so the book, The Alternative Investment Almanac, Expert Insights on Building Personal Wealth in Non-Traditional Ways, could be found on Amazon if you look for me, Denis Shapiro. The main reason I wrote that book was that bridging that gap between what traditional investors viewed alternative investments as and what alternative investments not, given the credit of what traditional investments could do. So that was my personal journey. And I had a 20-year journey of that. And I wanted to document that journey, but then I wanted to actually introduce investors to all these alternative investment spaces that they might not be familiar with. And if they are familiar with, it has a really negative connotation. So I wanted to introduce people to life insurance policies, life insurance settlements, the apartment building world, mobile home parks, multi-asset funds. So the way I structured the book is it goes into a high-level introduction into the asset class. It's about 20 to 30 pages of what you need to know. And then it goes into 2 Q&As with expert investors from that space, which the Q&As are actually my favorite part because everybody got the exact same questions. So whether or not they're a mobile home park operator, investor, or an ATM fund operator and investor, every single person got the same exact question. So you could see how they actually answered the question. So what the book will allow you to do is, let's say you're interested in learning about ATM funds. Instead of going out there and finding a book that is written by an ATM fund operator who will only tell you the positives of it, you could read 20 to 30 pages, decide for yourself if this is an asset class you might want to go down the rabbit hole in. And then you could go on, do your podcast and do your own research. Or you could spend that 20, 30 minutes and say, okay, you know what? This is not for me. I don't like the fact that, there is a high history of Ponzi schemes in this region. I'm going to go on to apartment buildings, which has less frequency of that, which is fine. So it's all about giving people a synapse, just a quick, bite size of what that asset class can actually do for your portfolio, and then the Q&As, and then it goes right into the next asset class.
Awesome, man. So I appreciate that, giving the high level insight on this space that is quote unquote alternative asset investing. I always think it's kind of funny because I feel like these assets have been around for a while and there have been more people investing in these types of things in the stock market. But anyway, we'll get into that kind of conversation or go down that rabbit hole. So listen, thanks for sharing that. And then you know what? We need to get into the lightning round, which is the going long final 3. But the thing is, Dennis, I never ask anybody the going long final 3. And today you're the guest, unless I ask you, unless you tell me that you're ready for me to ask you the question. So are you ready?
I think so. Let's do it.
No, look, you think so? No, you absolutely know that you are. I know you are. Here we go. First question is, and I'm going to guess this may be a little bit easier for you, but we started with you where you are on your side of the pond now today on that side of the Atlantic. And I want to bring it back over to this side of the pond and have you share with us, what is your favorite European city that you've either visited or is still on your bucket list to visit?
So this is definitely bucket list because I come from an Eastern European country. So my bucket list is definitely any city in Croatia that has those views of the, is it the Adriatic? Yeah, that water and the culture and stuff like that. I really want to. So I think it's between Split and Dubrovnik. But I don't want to say it incorrectly and offend anybody. But those are kind of like my bucket list item cities.
Right on. Fantastic. And Croatia actually as well is just country wise is one of my bucket lists. I've not been there. I've been to 86 countries so far, but I still have not been there yet. But I know I'll get there. So appreciate that. The other thing is something that I've noticed about really successful people. And I know that you're a successful person. And like I said, this is kind of a lightning round thing. But one of the things I've noticed with really successful people, Dennis, is that really successful people tend to be that way because they really have gotten to where they are because they get everything right from the very beginning. Like they don't make any mistakes. And that's typical. I think I get nervous every single time I ask that question. Or maybe it's just a joke. It's an inside joke with me and the Going Long family. But, and I see you're smiling. And if you're not watching the video version, you should go check Dennis's face out because he's got a nice smile on his face. But yes, as you know, that's not true. The thing is, really successful people, and this is true, I've noticed that they tend to make mistakes. But not just mistakes, a whole lot more mistakes than most people, Dennis, like a whole lot more mistakes than most people. But the thing is, they do something very, very differently. You've talked to us about a number of the quote unquote mistakes that you made early on, but very successful people tend to do one thing very, very differently. They stop, they learn from every single mistake or learning opportunity, especially the relevant ones. And they make sure that they put different tactics in place to minimize the chance of making the exact same mistake twice. So I would love for you to think about really not just the mistake that you made or the learning opportunity that you had. And I know this is a lightning round, but what is the one lesson that you know that the Going Long family needs to know today because it's going to help them get to their goals much faster?
Not to be scared of the mistake. Just like live it, love it, and move on from it. Like I literally, every single asset class that I've almost every single ever done has always started off with a mistake. Like my first traditional, first mutual fund, mistake. My first probably, individual stock picking, mistake. First single family rental, mistake. First apartment building syndication, mistake. And yet I now look in hindsight and I'm like, I wouldn't even classify them mistakes anymore. They were just they were just like a hiccup. And that's the point. It's like, you have to understand where like there's a difference between a mistake that has fundamental problems and a mistake because you did not do enough research in it. And I think really smart, successful people, they know which one is which. And they know if it's the fundamental issues, they usually say, okay, I'm not going to do any more of that. But if it's strictly like, hey, the investment has potential and it's on me to become better, put systems in place and do more homework and network with the right people, then I'm going to go get it. And that's exactly what I think. That's my best piece of advice.
Nah, I love that. Live it, love it, and move on, man. That's fantastic. Absolutely fantastic. And then lastly, Denis, we love to fill our minds. You're someone who's already a written author. I would love for you to share one book that you know that will make a positive impact as well. And like I said, we're going to include your book in the show notes. And I would recommend, that as the Going Long family, go check out the book, check it out over on Amazon, as you mentioned before. But Denis, what is one other book that you would recommend to us?
Yeah, so this one's a little bit unorthodox for a business podcast. But I found it extremely helpful. I'm in a couple of masterminds, and this book was recommended to me. And the book is called The 5 Love Languages by Gary Chapman. Yeah. And you know what? It is directed towards you and your spouse, but it honestly could be applied to so many things, like my business partner relationship. Like, you have to understand what other people value is completely different from what you may value. So you might think yourself the best spouse, and you might think yourself the best father, and you might think yourself as the best business partner. But in truth, if the other person values something completely different, you will, lose that relationship. And I've kind of went through a really tough time when I was going through my book and launching my fund, and I was overlooking certain things of how other people were looking at me. And I think that book helped me shift that perspective. And I highly recommend it to anybody. And he has a series. I'm actually reading the one with the kids now, with the children, and I'm trying to apply that to my own kids. And I can't recommend it enough.
All right, Mr. Chapman, The 5 Love Languages. And that is one that is definitely a helper for anyone who is looking to maximize the relationships and relationship building. So, wow, man, I cannot even believe we've gone through this conversation so fast. I love these conversations because they go by so fast. You've given so much value. You start telling us what, you're sharing with us as a 14-year-old who's investing $1,000 and going on those emotional up and downs and waiting and then going, wait a minute, I made $7 after a year. This has been absolutely insane. And then you kind of come back and then you decide, well, that's not necessarily the thing you wanted to do. And then you continue to move on. And then as you went through, you got your MBA, you did all of the cool things, and then you decided you wanted to get into real estate. You were fortunate enough that you had a brother who was already there, right? And when you ask him that great question, hey, listen, can I get one of those properties? He's like, yeah, actually you can. You had another lesson. And then the lesson was, well, you got into the property, but really quickly, as you started going through this particular type of asset and managing it and doing that firsthand, you recognize that you did not want to scale that business. Since then, you've gotten in, you've learned, you've gone just beyond real estate to develop a thesis that is really helping you to create an alternative investment almanac that is helping so many other people to figure out what is the right thing that people should be doing, what are the different tools that are available so that each individual can get to their goals and dreams as quickly as possible. Not only were you a limited partner and investing with others, you're now leading investments through your own fund. And you know what? I know that there's so many people in the Going Long family. I know that I can get in touch with you again easily, Denis, but also help the Going Long family find out what is the best way to learn more about you and what you're doing at SIH Capital Group as well, so that we can get in touch with you, man.
Yeah, I appreciate every person who ever reaches out to me. I never take that for granted. Best place to reach me is SIH capitalgroup.com. If you go on, you'll see I created 2 abridged versions of my book, one for the Q&A and one for the actual content. So if you go on, sign up to my email list, you'll get the abridged versions, and then we could see where the conversation goes.
All right, fantastic. So, well, Go Along Family, you found it there, SIH Group. Capital Group, SIHcapitalgroup.com. Check it out. Denis has made it very, very easy to find out more about him. He's got a couple of different versions for his book. Once again, the Alternative Investment Almanac. And listen, man, I really, really appreciate you can check him out on Amazon as well. I appreciate you investing your time with me and the entire Go Along family. So thank you so much, Denis.
Yeah, it's been great. Thank you so much for having me.
All right. Fantastic. And just a couple quick words for the Go Along family. Once again, it's been a great conversation. Denis Shapiro has left so much value, has really given you some, not just strategies, but tactical actions that you can take. Check out his book. He's making it really, really easy to get in touch with him as well. I know that I'm looking forward to welcoming you back on the very next conversation. So until then, go out and make it a great day. And thank you very much. Wow. Don't you love hearing from top-notch experts in the field? When I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.